Hey everyone, welcome to the 262 Market Report. Today is March 13th, 2023. Oh, what a week we have going this week. So let's talk about all the different things. Last Friday, the SVP Silicon Valley Bank collapsed. The Feds announced yesterday that they'll be making whole depositors, but not investors. But then today when the market started out okay, but then they shut down trading on 30 other banks. So it's a significant move by the Fed, by the government. Then this morning, if we're looking at right before I came on, the NASDAQ was up actually like about 1%. S&P was up about 1%. Well, why would that be? It seems to me that market forces maybe are thinking that the government took the right plan right now. And so that's kind of by clamping down on the other 30 banks and by also making whole depositors, but not investors. Remains to be seen what will happen the rest of the week. Day to day right now in this market, things are happening and it's always changing and how it affects real estate market. Okay, so let's talk about last week, what all happened. First, Powell was speaking before the House committee, and after he got done speaking, it seemed much more likely that the 10-year or the rates next month will go up, the 0.5. We've been kind of thinking it'd be like 0.25%, but after he got done speaking, it seemed like it'd be 2.5. The next day, housing comes out, and the housing elevated a little bit, not past expectations, so that kind of tempered. It was almost like good news for the rates and how it'll affect the mortgage rates. Then on Friday, the bank collapsed. So how does that affect the rates? And generally, what has happened is that by the Fed continually pushing the rates up for the last short amount of time, that's really one of the things that impacted the collapse of the bank. And so I think that made people think, okay, maybe they're going to pull off. So it's like if you think about the week, it's just, Powell, then jobless report, then the bank collapse. And where we stand right now is that the 5-year or the 10-year rate is at 3.5. So what we like to think of right now in this market is that generally you had 2%, and that's going to be getting you kind of toward or 3% is going to get you toward your rate. So right now the 30-year was at 6.79. Earlier last week it had been pushing 7, and now maybe with what's happening, all tying all these things together, especially with the banking and the jobless reports, maybe the Fed will ease up when they raise rates next month. But of course, that's like 3 weeks away, and a lot can happen between now and then. So let's see here. So it's actually uncommon for how quickly that the 10-year rate is changing. And I think that's because of the unusual things in the market, but then also the Fed, kind of tinkering again, because the tool that they have to ease inflation pressure, they don't really have jobless. So their key that they can use is inflation. So they're kind of playing with that more. And so we've kind of seen uncommon changes week to week so much in the 10-year rates, which then again affect the mortgage rates. Not surprisingly, because rates are, between 6.5 and 7, we've seen an increase in adjustable mortgage rates, ARMs, as they're commonly known. Let's see, last week, we saw a raise last month of 10.3% in the increased use of ARMs as opposed to conforming types of loans. So I think people are thinking, all right, this is a short term, maybe that's completely elevated rate. Let's take a risk not a risk, but let's take the opportunity of a 5-year rate. What happens with a 5-year rate is, you have a lower rate, but then after 5 years, your rate can start escalating 1% or 2%, depend, some amount each year. But in the meantime, a lot of people, they like to, say, okay, in 5 years, it's going to be less than the 7%. I'm going to take this risk. I'll refinance. This is one of the things that it's really important to talk with your lender and have them do an analytical review, because you might be surprised, like the cost of having a 5-year, it is like so many years out before your cost benefit analysis is not the same if you took the 5-year or the conventional. All right, so what's happening in Ozaki, the Fort County area? Last week, there was, I think, home sales of closings of 107. The year before, it was nearly double that. Ozaki County mirrored those numbers last year or last month. last month, I think there was like 21 closings in Ozaukee County. Last year, about 35. So what we're seeing is that our homes on the market are about half of what they are the year before. Our closings are about half of what they were last year. And, in other markets, when you maybe just had decreased, if you had high rates like we do, you would think not enough buyers. And then if you had also lower home listings, you think that, buyers might have a better chance, the ones that are out there. But the fact is that they're both kind of depressed at the same rate. Lower listings, lower buyers, maybe the listings even more. So our buyers, depending on what they're looking for this week, are still struggling to maybe get their offers accepted. You have to kind of look for maybe the homes that need renovation. Maybe you need to get a rental loan, or maybe homes that you can put your own stamp on it. We're still, like I like to call them glossy houses. Glossy houses are still going really quickly. Agents are leaving them open through the weekend to get accepted offers. And we're also seeing that they're not quite as glossy, they might make it through the week. If they make it through the week, I think that agents are coming in with bigger, or less, I should say, less, like less on the inventory or inspection, less on the inspection adjustment, not maybe giving any appraisal gap. Whereas on that first weekend, if you're in the glossy houses, you're probably coming in with some sort of inspection contingency and appraisal gap. And so you really need to understand the market, because I would say maybe last spring it was all home purchases were no contingencies or low contingencies. This year it really depends on what you're buying. What do we have coming up this week? Well, first of all, it'll be interesting to see what else happens with banks. Is today that when they shut down trading on the 30 banks, is that it? And when by that, is there like no more banks, being shut down, no more banks having a run on their money? So that's one thing we'll have to see, and that's not scheduled. On Tuesday, the CPI, Consumer Price Index, the Core Index are coming out. So that's kind of the inflation index. So that'll be interesting to see. Then on Friday, we have some more. We have on Friday, we have, the U.S. economic leading indicators. So those are, kind of giving a little bit of a future, like what is going to happen. So the indicators, what are we seeing happen with those? So that's what's kind of happened. It's a crazy week. It's really a unique time in real estate, with all these factors kind of swirling, banks, employment, housing, listings, rate, all this. And so it's really important that you connect. Your agent is really informed on the market, is out there showing homes. They know what buyers are looking for from a selling standpoint, like list your house right, and it's going to go. If you have any questions, reach out. I'm Jennifer Zeller with Realty Executives, the Red Shoe Realtor. And this is the market report for January 13th, 2023.